Good afternoon, everyone, and welcome to today's exclusive webinar, Retirement 101 Financial Preparedness for Your Next Stage. My name is Charles Liu, Trust Sales Officer, and I will be your host and moderator for this afternoon. But before we begin, may I remind everyone to type in your questions even while presentation is ongoing so we can ask them later in the Q&A portion. 2020 has been an unprecedented year as we continue to move towards normalcy. It is the bank's fervent hope to be with its clients as we navigate and thrive together amidst these uncertainties. As we begin to think beyond the current COVID-19 pandemic and emerge from its unprecedented disruption, what can we do today to help ensure we emerge successfully? In this afternoon's presentation, we will be covering the topic of Retirement 101 Financial Preparedness for Your Next Stage. As your trust partner, we know how important it is now more than ever for you to be well informed and constantly be updated on the changes in the economic environment. And this webinar series was created in response to that need. I hope this afternoon's session will provide you with insights that will help you prepare and make sound decisions for your retirement plan moving forward. Metrobank will continue to support you with meaningful solutions to protect your legacy. To begin our program, our speaker today has over 20 years of experience in the banking industry and has been a trust practitioner all her professional life. She is an alumni of the University of Philippines, Diliman. As head of the Accounts Management Division, she takes care of all existing trust clients of Metrobank, ensuring that all arrangements are properly managed and administered. She's an expert in providing trust solutions for wealth building, wealth management, and even wealth transfer. She is likewise adept in assisting corporations in their setup of employee benefit trusts. Please welcome Wanda Beltran.
Thank you, Charles. And good afternoon, everyone. Thank you for attending this webinar on retirement planning. An East Asia retirement survey conducted by the Global Aging Institute several years back revealed that about 9 in 10 or 90% wake at night wondering how they can stretch their money when they retire. This as they struggle with little savings and almost no government support. Um, Many are very anxious about exhausting their savings, being in poor health, and having no one to care for them or being a burden on their children when they retire. Although many Filipino retirees do not have pensions and personal savings, almost all can count on the support coming from their extended family. But as the Philippines modernizes, retirement attitudes and expectations have also changed. The survey showed that now only 1 in 10 Filipino workers believe that the family should be mostly responsible for providing income to retired people. Majority also think that it is the government's responsibility to save more for retirement and that there should be efforts to require employers to offer more jobs to the elderly. There is also a prevalent sense that taxes should be increased to provide for a basic pension benefit. Now, one alarming output in the survey, in the study, was that the Filipinos are the least knowledgeable when it comes to using financial instruments for retirement. As a matter of fact, only 8% expect to receive income from financial assets like insurance, stocks, or even bonds, while 68% expect to receive benefits from Social Security system or pag-ibig. Thus, it is comforting to see that more and more Filipinos like yourselves are now realizing the importance of savings pensions, and investments. Generally, people only begin thinking about planning for their retirement when they reach their late 40s or early 50s. One of the things that this pandemic happen anytime and sometimes can be out of one's control. Many now are without a job or unable to find one and unable to find one. Even worse are those who can no longer work for a host of reasons, such as poor health or the need to stay at home to attend to children being homeschooled, etc., etc. So if you're in your 20s and in your 30s and attending this webinar, you're in luck because you will have the most to take away from this session. So the first lesson that I'd like you to take away is this: stop associating retirement with age. Rather than think of it, rather think of it as a state in your life wherein you no longer have to work for money. By doing so, you can make this a goal, you can make it a goal no matter what stage you are in your life. Ideally, planning for one's retirement should start upon employment. Okay, so I hope there are a lot of young people in the audience, okay? But if you're not in that group, no worries, you'll still learn something. So it should start upon employment. And I say this even more emphatically for the young people of today. Why? Because studies have shown that the two principal state pillars of the Philippine pension system, which is the GSIS and the SSS, as well as the smaller auxiliary programs, are not sustainable in the long run. Remember the news when they said that the SSS pension fund would go bankrupt in 2026 if we were to raise the pension payout by 1,000 pesos? And how about retirement plans which are offered by private companies? Frankly, my friends, even if one is fortunate enough to land a job that in a company that pays a good retirement package, the frequent job hopping of so many young people makes it less likely for them to stay long enough to qualify or become eligible for such a benefit. And it is for these reasons that we need to do our retirement planning. Retirement planning is not just financial in nature. It also involves personal planning. And personal planning answers the question, what kind of life would you like to have when you retire? Financial planning, on the other hand, will help you determine the retirement fund that you will need for the kind of life you want. The next speaker, who will take on the more exciting portion of showing you the math behind the planning, will discuss with you. Will handle the more exciting portion of showing you the math behind the planning. So be sure to stay for that. To stay on for that. Okay. So just a few more reasons. This I am also controlling my slides. So why plan at all? Number one, almost half of the retirees report leaving the workforce earlier than they had planned. Some do so on their own volition because of a windfall or an investment that paid off. But many, my friends, retire because they lose their jobs and they can't find a replacement. Or sometimes they had to do so because of ill health, either their own or a loved one's. So, what am I saying? So, while working longer can help you make up for not saving enough, it's not an option you can always count on. Number two, increasing life expectancy. Believe it or not, some people don't plan because they think that they will die early or they will die young or at least early. The average life expectancy in the Philippines in 2019 is just under 72, and it's ever increasing because of advances in science and technology. If you make it to 65, you can expect to live for another 20 years. actuaries, half of women currently in their mid 50s will live to the 90s, as will 1 in 3 men. And of course, the healthier your lifestyle and the higher your education, and higher education tend to make you live longer than the average. Now, number three, with rising life expectancy and healthcare costs, expect that medical expenses will dominate your retirement expenses. Next, you need to plan because retirement, much like marriage, is a major life changing event that will involve an ongoing process of emotional adjustment. If you don't set new goals for yourself or find more meaningful things to pursue, you may end up feeling an overall sense of loss, such as a lack of social interaction, a lack of purpose, or a feeling that you've reached your peak and are no longer needed. So plan so you don't have to go through that. Next, you need to plan because the conventional career path is something like this. You pick a job, you advance in that job, you draw higher and higher salary, and eventually you retire with a benefit. Now, there is something flawed in that. If you think that this will work, then believe me, you are setting yourself up for potential financial difficulties and even a longer time to retire. Remember this. By having multiple streams of income, you are protected in case you lose a job. You have more paths to accumulating, and of course, you have more flexibility for the future. Next, you need to plan because you cannot rely on your children. You cannot depend on your children. Here are some reasons why relying on your children for retirement is a big, big mistake. Number one, they may be unable to support you even if they want to. Handling your finances allows you more privacy. You don't want to be a burden to your children. And finally, because that your retirement needs better than anybody else. Retirement planning is also important because sometimes you don't just do it for yourself. The retirement plan of a married person will completely be different to that of a single person. And if you have kids and elderly parents who depend on you for support, that may even further complicate your retirement plan. So, friends, when you plan for these realities and learn about different options, including the consequences of each choice, you're less likely to face unpleasant surprises and financial struggles that could prevent you from retiring when and how you want to. And finally, remember this. When you start investing during the early stages of your life, not only does it help you create a much bigger nest egg, but it also reduces the financial burden of investing a lump sum amount just so you can create a retirement fund. By investing at an early age, you buy more time for your investments, allowing you to become more aggressive and fully enjoy the compounding effect of earnings. To get started, these are things you need to do. Now, majority of what you will see on screen are self-explanatory. So I will just highlight on a few. Planning where you live. It's housing and household expenses represent the top expense in a retiree's budget. Therefore, where you retire will definitely have a big impact. So you may think about selling your house in a expensive location and moving to a city with a lower tax rate, or you can decide to downsize your home, from living in a big house to probably staying in a condominium. So if that is the case, then definitely your expenses will go down, and you can allocate such expenses to more priorities. On the flip side, You can also decide to move in to a closer place, to a place that's closer to your grandchildren or your children, or probably retire overseas, and that will mean more expenses for you. Therefore, planning is important. Now, next I'd like to highlight number 4, which is calculating your likely retirement income. Now, friends, just for your information, as of July 2019, the SSS, the highest pension paid by the SSS was at 18,945. So let me say that again. 18,945. And the lowest pension paid was 2,000 pesos. Okay? So that's what you will get. That's something that you will get, assuming you're a member of the SSS. Now, if you're looking at the private retirement plan, based on the plans that we manage here in the Trust Banking Group, the benefit ranges from 100% to as high as 300%, depending on the generosity of your employer. So, if you retire, assuming you retire after 30 years with a salary of 200,000 pesos, that would translate to a benefit package between 6 million to 18 million, depending on the factor that you use. Now, remember this, however, and I talk to those who are employed now. The retirement prescribes a minimum of 100% or 1 month's salary for every year of service for retirement. So your employers are in no way obligated to give you more than that. Okay? So when you choose to join an employer, that is one of the things that you need to look at their retirement package. Now, relative to your retirement goals, so these are also, again, some of the things that will get you started on your retirement plan. But relative to your financial goals, to the financial goals of your retirement plan, you need to be able to adjust as your age matures. And I'd like to show you an example of how to do it. So, if for someone in their 20s, the goal really is to imbibe the discipline of savings. So you need to decide, how much do you want to save? Is it 100 pesos a day? Is it 1,000 pesos a month? Decide on that and do it. So that's the goal when you're in your 20s. Once you reach your 30s and have accumulated excess funds, and I say excess because part of the saving means putting up in case you decide to change jobs. So, assuming that you already have excess funds, then you can decide on an asset allocation strategy and diversify accordingly. With the age of UITFs, this has become much easier. Back in the day, I remember they would require heftier amounts just for you to invest in basic assets like bonds, but that's not the case now. So, really, you're in luck. Now, when you turn 40, this will be the time when you build on other aspects of your wealth, like getting a home and raising a family. Thus, the goal really in your 40s would be to stay in track when it comes to your savings and investments, no matter how big your expenses are. So don't make it an excuse, my friends. At 40, stay on track. When you're 50, then this is the time when you try to speed up on your savings so that you can meet your goal and probably do some major catching up if needed. What comes to mind here is, assuming, if for example your company has a retirement plan that allows you to do contributions, why not put in the maximum? You can have bigger catch ups when the time comes. Okay. And finally, when you're 60, you must put in place an income strategy that will help outlast your retirement reserves. At this point, you may consider talking to a financial planner, or you may even shift to a more conservative portfolio strategy, or decide to set up an additional fund just in case for unplanned expenses. So, before I end, and turn you over to our next speaker, I'd like to reiterate on some mistakes to watch out against. Believing SSS and your company pension is enough. Without me belaboring the point, Dondi will show you later why this is such a no-no. Number two, investing more in your children over yourself. We all want our children to be successful. But if it means supporting them through multiple college degrees or paying for your grandchildren's education when you are retired, may lead to your own financial life when you are most frail. So think about it. I've seen a lot of retirees who, upon receiving their retirement pay, would go about and buy a car for their buy cars for their children. You know, give gifts to their families. I think you should think twice before doing so. And finally, the third mistake is failing to consider cognitive decline as you age. Even if you have a plan, my friends, making sure that it is executed to the letter may be a challenge given this reality. So you may want to consider legal schemes which are carried out accordingly, even when you can no longer have the capacity to decide. This is where trust arrangements come in handy. So, I hope that I have laid out the groundwork and I was able to convince you on the importance of planning for retirement. Ladies and gentlemen, retirement planning is thinking about tomorrow today because the only person who will take care of the older you is the younger you. Thank you, and I now turn you over to Dondi.
Thank you, Wanda. I love how Wanda stated facts that most people fail to consider when building their retirement fund. While some of us are able to do well come retirement because of the businesses that we have set up, a lot of us are unable to adequately estimate other retirement expenses. It is essential to have set aside enough, especially if you don't have sources of income anymore by the time you retire. Just a quick reminder, key in your questions so we can discuss this later in the question and answer session. To discuss and talk about how to achieve your retirement goals, our next speaker is a seasoned economist with almost 20 years of professional experience. Having worked in Singapore and New York before settling back here in the Philippines, where he now serves as Senior Vice President and Head of the Metrobank Trust Banking Group, please welcome Dondi Santillan.
Hi, good afternoon, guys. I'll go through some simple math so that we can prepare for our retirement. These are based on a lot of assumptions, and they're very rough numbers, but at least it gives you an idea of how much you need to set aside, depending on what age you are. No? You know, before I get into this slide, I wanted to share with you something. You know, this is my favorite anecdote. It's about inflation and purchasing power. They say there are only two things certain in life. One is death and taxes. Death and taxes. I think another certainty in life is that your money today will be different from money 20 years from now, 30 years from now. Over time, our money diminishes. Things get more expensive. So what you can buy 100 pesos 30 years ago will not cost just 100 pesos today, but in fact more. No? So that's one certainty. One example I usually use is when my dad bought insurance in the 1970s worth 1 million pesos. Back then, that was a lot of money. This is a joke, but unfortunately, he's still alive, and really, that 1 million pesos is paltry compared to what it was 40 years ago. So over time, your purchasing power diminishes, and really, the reason for that is inflation. We don't notice it 1-2 years from now, but if you look at it over an expanded period, it looks big. So, for example, in this slide, For example, in this slide, your 100 pesos in 1990, based on an inflation rate of around 5.38% per annum, which was average inflation over the last 30 years. Today, if what you can buy for 100 pesos, you will need to pay 550 pesos, or a 450% increase over 30 years. This is real estate. This was from a prime property in Makati. In 1990, it cost 10,000 per square meter. Now it's 455,000, or a 4,450% increase. Tuition rates in 1990 in Ateneo at that time, cost 27,000 per annum. Right now it costs 190,000, or almost 200,000 per year, or a 600% increase. In fact, because tuition is not regulated, private school tuition, this has increased more than inflation over time. That's why a lot of the educational plans, or the companies that offered educational plans, could not meet their obligations, was because they cannot meet the same, or they cannot invest in the same assets that grew as fast as tuition. This is interesting. The price of Jollibee in, I think this is Chicken Joy, in 1990 was 34 pesos. Right now it's 99 pesos. It only increased 191%. So this is a representation for food. It's funny, I saw a YouTube clip showing how big a Big Mac was 30 years ago versus today. The size also diminished. So maybe the reason why the price hasn't increased so much is they also decreased the amount or the portions being served. So it's not really reflective. But bottom line is, there are a lot of things that grow faster than inflation. Inflation grew 450%. Real estate grew 4,400. Tuition grew more than inflation. And then this food seemed to have been stable. 20% of inflation is food. And most of the basket of inflation is food that's regulated, like rice. But in reality, it's not a good representation of price increases over time. It really is a good indication of how much inflation is growing for the class C, D, and E, because the quality of rice is not the rice we eat at home. This is the rice that the C, D, and E eat at home. So in fact, even when I say inflation grew by 5% per year over the last 30 years, in reality, for those in class A, B, probably the cost of living increased more than just 5%, given this facts. So why am I telling you all this? So this will determine how much we need to save in the future, assuming you're of a certain age right now. So let's look at this example. 2021, I have this friend called John, an office mate, very successful. He's already an assistant vice president in Metrobank. Right now he's single, lives a good life, spends 100,000. By the way, the reason we used this amount was because we wanted the numbers to be round. So we kept it at 100,000 per month. His appetite's aggressive. He pays mortgage but wants to save for retirement. So like I mentioned earlier, the average inflation rate over the last 30 years was 5.85%. But in reality, cost of living increased more than that for the class A and B people. Although I think inflation at 5.85% over the next 30 years is most likely unlikely, because inflation improves over time as the country gets more developed, we can become more efficient. So the number will probably be lower, the headline inflation print. But like I said, cost of living probably grows more than inflation anyway. So 30 years from today is 2051. He's married with 2 kids, age 60. So the question is, if he's happy with 100,000 per month and he thinks that's the kind of lifestyle he wants to maintain after he retires, what is the amount 30 years from now, given into consideration the purchasing power decline? So the answer to that is 400,000, or almost 4 times 100,000. So his monthly expenses in 2021 was 100,000. Assuming the same type of lifestyle, you will need 400,000 per month when you retire 30 years from now. He wants to live on interest. That's a plan. He wants to preserve capital for children's inheritance, no? So how do we come to the amount 400,000? So the idea is to live on interest of 400,000 a month, and the balance to pass on to children over time, right? If you need 400,000 per month, and assuming when you reach 60, your investment profile changes from aggressive to moderate because you want capital preservation, so you'll just be investing in bonds, and we assume the bond rate to be 4% net, which is actually quite high right now, no? So it's 100% bond mix. So to do that, you need 120 million saved by the time you reach 60 or 30 years from now. So first, let's look at the math, no? So 100,000 today at an assumed inflation rate of 5% for 30 years. Doing the compounding, 100,000 times 1.05, 5 being 5%, raised to the 30 years, gives you more or less 400,000. In fact, it's a little higher than 400,000. So in other words, your expenses in 30 years will increase 4 times, from 100,000 to 400,000. Assuming your expenses right now is 50,000, you just multiply it by 4 times, it will be 160,000. Okay? And that's a math in it. So that's how much I know I need per month when I retire. Next is, how do I get to the amount of 120 million? So assuming I want to live on interest and the interest rate is 4%, and I need 4.8 million per year, because 400,000 times 12 is 4.8 million. So 4.8 million divided by 4, you will need 120 million approximately. So that is what you call your goal or your nest egg. So I wanted to show you an example. So the first case is, you start saving at the same age, but different assets. So in this case, you have conservative represented by cash, moderate represented by bonds, and aggressive represented by stocks, all at age 30. So let's say the cash portion or time deposit, when we say cash, it's time deposit, earns you 2%. So at 2% per annum, you need to have a monthly contribution when you start at 30 of 240,000 per month. If you go with bonds, which has a higher rate of return, but slightly riskier, you will only need to save 170,000 per month at age 30 onwards for 30 years. However, if you're very aggressive and only invest in stocks, and assuming a return of 15%, which was the average return over the last 15 years, or 20 years rather, you will need to only contribute 7,000 pesos per month. The reason the contributions are much more with more conservative funds is, one, at 2%, you don't even beat inflation, assuming inflation at 5%, right? You're in fact what you call earning a negative interest rate when you net inflation. So you really need to contribute a lot. And the big risk here is, one, you don't have enough money. If you try to save 240,000 pesos a month, that's a lot of money, especially when you're 30 years old. Likewise with bond, you hardly beat inflation. So the big risk, I think, for most Filipinos, and I think Wanda hinted at it earlier, no? In the region, and I think in the world, we have one of the lowest savings rates. In fact, inflation is made up mostly of consumer spending. The tendency is we spend what we earn instead of setting it aside. Okay. Second weakness of the Filipino, I think Wanda also hinted at it earlier, was that our financial awareness is not as high as our neighbors or as the rest of the world, particularly developed markets. So for a lot of us, 90% of Filipinos are limited to bonds and cash. In fact, the retail participation in the Philippine Stock Exchange is only 1%, at least last year. No, that's probably increasing. So 99% don't even invest in stocks. As you can see here, if you get a better rate of return, you have to save less. You can save less per month or set aside less money per month. And this definitely beats inflation over time. Take note, there's more volatility in stocks, but if you hold on to it for a long time, volatility decreases over time. Okay? So moral of the story, diversify to maximize potential returns for your retirement. You cannot stick to just time deposit and bonds because that has a negative carry over inflation. And like we saw, if you're comfortable at 100,000 per month, 30 years from today, that will multiply by 4 to 400,000. We will not be able to do that if we keep on sticking to just cash and bonds. And when I say stocks, I don't mean just local stocks. I also include offshore stocks. Okay? In fact, these are not the only asset classes available. You also have real estate, etc. So you have to consider all asset classes, but sticking to cash and bonds is a very risky proposition. Very risky. It means that you will not be able to save enough by the time you retire. Second case, all the same asset this time, but at different ages. So Jack started investing at 20, or saving money at 20, or setting aside money at 20. Jose started saving or setting aside money at 30. Peter started setting aside money at 40. We assume they're all aggressive, all in stocks, and all the same returns. Jack, if he started early, would only need 4,000 pesos per month until he retires. Jose, on the other hand, because he started much later in life, will need 17,000 pesos. And Peter, who only started at 40, will need 80,000. Because for Jack, he has 40 years to save, and there's a compounding effect on the investment. For Jose, he has 30 years to save money. And for Peter, he has a mere 20 years. That's why he needs to shell out more money. So moral of the story is, the earlier you invest, it's easier on the pocket. Okay? So there's no such thing as too early. In fact, try to start as early as possible. And that's I think part of Filipino mentality is once they start saving money, they want to buy cars immediately, they want to buy a house, they want the nice living. The problem is, you might not be prepared by the time you hit 60. So let's assume a 50-50 mix of bonds and equities, okay? The blended yield is 9.5%, and your goal is 120 million, which is the numbers we showed earlier. Your monthly contributions, if you start at 20, because this is not all aggressive, the previous slide was all aggressive, meaning all stocks. This has bonds in the portfolio. Again, I think you have to be diversified. You cannot just be all stocks. No? In fact, as you age, probably the stock portion decreases. No? As you're earlier in life, you can start being more aggressive, but as you approach 60, you should be mostly in bonds. No? So if you started early, you'd need 20,000 a month. In the 30s, if you started at 30 with 30 years to go, you only need 60,000 a month. If you start as late as 40s, you need 170,000. And 50s, because you only have 10 years left, you need 600,000. So the takeaway of this is, the earlier you start investing, the easier it will be in the pocket. And two, diversify. Do not stay only in bonds and time deposit. You're earning a negative carry versus inflation, and you need to set aside more money. You have to consider other asset classes to augment your, or to help with your nest egg planning or your goal planning. Again, I say this is very simple math. It can get more complicated. We can show you examples where, assuming after 60, you assume to live 20, 25 years till you're 80, 85. We can make it that such that you have an annuity that you end up with zero, which means you'll need to a smaller nest egg. So, the point is, this is just simple math. In the end, you still have to approach professionals and ask for a computation. I think I'll end my session at that. I just presented the simple math. Thank you.
Thank you, Dondi, for your simple math. So a lot of you might be wondering how you can take the first step into having a comfortable retirement and start investing already. So I'm here to present to you the investments you can have to build your nest egg. Of course, you're all familiar with the checking or savings account. You're also familiar with time deposits, which give higher returns than savings accounts, but they give minimal returns. Now, what we'd like to focus today are UITFs. So what is a UITF? Unit investment trust funds are open-ended pooled trust funds in any acceptable currency operated by a trust entity and made available by participation. UITFs are established, administered, and maintained by a trust entity subject to BSP approval. Here are the benefits versus the risks of investing in UITF. Although the returns are not guaranteed and the investments are not insured by PDIC, you can potentially have higher returns if you invest in stock funds and bond funds. Affordability, you can invest for as low as 1,000 pesos in our UITFs. Diversification, because you are able to invest not just in bonds and stocks, but also in other global markets with UITFs. And the funds are professionally managed by experienced fund managers. So in Metrobank, we currently have 25 different UITFs that you can choose from, ranging from peso fixed income funds, peso equity funds, dollar fixed income funds, and dollar feeder funds. We also have the Para Funds, which was launched by BSP a few years ago to promote the personal equity and retirement of Filipinos. If you're interested in our Para Funds, you can subscribe through seedbox.ph. Again, UITF features affordability for a minimum investment for as low as 1,000 pesos. It's professionally managed. It's very convenient. You can transact online via Metrobank Online if you already have an existing UITF account, and diversification to different asset classes and global markets. We also have Aspire feeder funds. These UITFs have an auto-invest feature or a regular subscription plan. A regular subscription plan is a feature of the UITF where you contribute monthly to your UITF account. No need to go to the branch, no need to sign documents. Everything is done automatically. You can do it for as low as 2 years or up to 5 years. For as low as 500 pesos monthly. What are the benefits of the RSP? Disciplined investing. If you're having trouble committing to investing, then this may be the perfect solution for you, because once you subscribe to the regular subscription plan, you will have to fund your account so that your account gets debited for your investments. Also, cost averaging. No matter what the prices of the assets are, you are invested monthly. And also convenience, because you don't have to go to the bank on a regular basis to add your investments. So for those who are first-time UITF clients, you can visit any Metrobank branch to open your UITF accounts. And for those Existing clients, you can transact, subscribe, redeem, open new funds through Metrobank online. Thank you again, Dondi and Wanda, for the insightful presentation earlier. Before we read some questions, we'd also like to request everyone to provide your feedback on this exclusive event. You have the option to either use your smartphone and scan the QR code flashed on your screens, or click on the link at the right part of your screens. Now let's proceed to the question and answer portion. We have Dondi and Wanda. So for the first question, it's for Dondi. Will it be better for me to invest my available funds in the financial market or in land with the objective of selling it when I'm nearing my retirement?
I think land is a good investment option, no? As is financial securities, including equities and bonds. We have to recognize or acknowledge that these are legitimate asset classes, right? And land does appreciate over time. I showed you the graph earlier where land increased that much over the last 30 years. The question is whether it will increase that much over the next 30 years. The thing with land is you have a finite amount of supply. It's not like our land is growing, with the exception probably of MOA, where they're reclaiming territory, no? And as the population increase, and people get more affluent, there's more demand for land. So I think it has to be a mix of both. But take note, if you do buy land, that's a non-earning asset also, meaning it's not like you get coupons every month or every year. It's really purely capital appreciation. So that's the drawback for real estate. But having said that, given the finite amount of land available, over time, it should increase, no? As demand continues to increase with our population growth and our shift from an emerging market to a more developed market as we get more affluent, no? So you have to have a balance of both. And when you do land too, you have to differentiate between utility and speculation. Or when I say speculation, for investment purposes, utility is when you live in the property for your own house, or whether you're doing it just for pure investment.
Thank you, Dondi. For the next question, it's addressed to Wanda. How do I fit in the milestones like weddings, buying a house, and starting a family into monthly contributions?
Okay, so how do you fit in? Well, first of all, you need to find out exactly how much such milestones will cost. Will cost you. I think it's easy enough for you to know that. You go to a wedding supplier, you know how much the kind of wedding you want and how much that would cost. So that's easy enough to know. So I guess the next step will be determining how much you need to set aside in order to meet that goal, dependent also on the timeline that you've given yourself. So now remember that these are other expenses that you need to consider in your life, not and do not necessarily add up to your nest egg, the retirement nest egg in the future. So what am I saying? So other than having to save for retirement, there are other things that you need to save for. And people don't realize that they postpone. Sometimes they postpone saving for retirement, thinking about the more immediate life events go through. Yes, you need to save, and part of the planning, like what Dondi said, part of the planning is putting down the math. You might have a shorter time frame meeting that goal because you don't get married at 60 years old. So you need to do the math, sit down and save as well, on top of what you're saving for retirement.
Thank you, Wanda. I think we have time for two more questions. This one is for Dondi. Cryptos like Bitcoin, Ethereum, are the best performing assets these days. Several big financial institutions and companies are starting to embrace them. Will these be a good option to invest in if I plan to use proceeds for my retirement?
With cryptos, I think we have to acknowledge that it's an asset class. Um, but the problem with cryptos is the volatility is quite huge, no? Um, Bigger than equities in terms of volatility. So it's not meant for everyone. It's really meant for really, really excess cash, a small percentage of your portfolio. And you also have to understand the product. So I'm not dismissing it. I'm saying it is an asset class. It may have a place in your portfolio, but you also have to understand the volatility in it. And the question is, the performance of cryptos has been good the last year, but it was bad from 2017 to 2020, no? When the Bitcoin went from 20,000 all the way to 5,000. So you have to be able to stomach that kind of volatility. And in the previous webinar, there was a question similar to that, no? Somebody was saying, should I convert all my time deposit to cryptos? Those are totally two different asset classes. I assume the person in time deposit is very conservative in nature. That's why they're in time deposit. So shifting to the most aggressive asset class might not be a smart idea. I mean, if you allocate some of your equity portion into that, then that makes more sense rather than somebody who's just exposed to time deposit and only knows time deposit.
Thank you, Dondi, for that clear explanation. One more question. For this one is for Wanda. I recently retired. Where do I put my retirement benefits to ensure that it will last?
Okay. So if depending on what your expectations are, I would think that because you are retiring, you would need to live off on the interest of your or the interest from your retirement benefit. So um, that would probably mean you creating a bond portfolio where you can have a regular income stream in terms of coupons. How do you go about doing that? Well, you can go to the nearest Metrobank branch, and we can help you. We can help you in that regard.
Thank you, Wanda. We have one last question. It can be for either one of you. Audience might be interested in knowing the difference between UITF and VUL of an insurance company. So, what are their main differences?
VUL is a investment product that has insurance attached to it, no? And UITF is also a collective investment scheme without insurance. Depending on your need, I did have that anecdote earlier about insurance of my parents in the 1970s. Insurance over time loses its value. Meaning you could have been protected for 1 million pesos in 1970, but if you don't use it in the next 5-10 years, then that amount diminishes over time also. I think also not to, so it's really protection. You have to think about it as protection. I think one more glaring thing, the difference between VUL and UITF, and it's not like I'm saying there's no benefit to VULs, but also the expense structure, no? The UITFs have fees of anywhere from 0.5% to 1.5%, versus VULs start probably at 2 to 4% because there's wraparound fees there, and that's hidden. So for the same investment product, if you give away 2 to 4% per year and you're only earning a bond that only earns 4%, that's a problem. So, but there's that added benefit in VULs where you're insured. So that's it, basically. And Wanda, I don't know if you have anything else to add to that, no?
Okay. Thank you, Dondi. I think we have time for one last question. This one is for Wanda. What investment tips can you recommend to a 20-year-old that needs to pay household bills first for the family before being able to religiously allocate money for investing?
Okay, this is one tip that I'd like to give to the young people. When you talk about saving or investing, you treat it also as an expense. Rather, yes, treat it like an expense you need to do every month. So this is the concept of paying yourself first. So pay yourself first, and then you will discover that how easy it is to actually save if you make that mindset that the money that you're saving, you're setting aside, is actually part of the expense that you need to pay out every month. When you do that, then your paradigm shifts, and I tell you, it's going to be much easier for you to save up. To the 20-year-olds, I tell you this: you can start. Is that 500? Is that 100 pesos a day? You will begin to discover that it's easy enough. The loose change in your pocket, set that aside every day. That's saving.
Thank you for that, Wanda. Anything to add, Dondi?
Yeah, can I add something? There was a question on the chat that I wanted to address. No, yes, he said based on Dondi's presentation, it's not realistic to expect a 15% return annually on equities. Historically, returns are only 8 to 10% per annum. No, siguro we used 15% just as an example. No, but is it impossible to reach 15%? Probably yes, if you just consider Philippine equities. That's why I said we also have to look at offshore equities. There are a lot of opportunities offshore, and in fact, we're coming out with a fund, hopefully the next month, no, that will allow us to invest in technology, artificial intelligence, thematic funds, no, digital health, and the returns of those are at least historically, the last 2 or 3 years have been like tremendous. So if you mix it with local equities, then you can actually achieve 15%. Take note that there is volatility there, but if we stick to the Philippine stock market, where only 30 names are in the index, gives us little exposure to technology and other companies that are benefiting from this pandemic. For instance, over the last year, if only there was stocks on Lazada and GCash, I think that's where you should put your money. But unfortunately, there's no direct investment in equity markets for that. But once you go overseas, you have that available as part of your portfolio. Again, the number we used at 15% was a number we just got out of the air, but is it achievable? Yes, if you mix it with offshore investments. So I just wanted to end with that so that doesn't go unanswered.
Thank you for clarifying that, Dondi. Yes, we do have funds that are doing more than 15%, especially in the global markets. I guess that's it for the question and answer portion. I hope we were able to cover all your questions. Dondi, Wanda, is there anything else you want to say before we wrap up?
Maybe for me,
save early. That's it.
Yes, save early.
Yeah.
True.
How about you, Wanda?
And there is not there's a lot of help available to you, to all those who want to save, for all those who want to invest. Go to the nearest Metrobank branch and we can get you on the way to your goal. Thank you and good afternoon.
Thank you again, Dondi and Wanda, for being with us today and for what you have shared with us. We hope everyone gained insights from your presentation this afternoon. And thank you everyone for your questions. Before we end this session, we would appreciate it if you can spend a minute or two of your time and answer our short survey. You have the option to either use your smartphones by opening your phone's internet connection or Wi-Fi connection and use the built-in QR scanner, or if you have a QR scanner app, to scan the QR code that's flashed on your screen. You may also use your desktops or laptops by clicking on the link at the right-hand part of your screens. This will only take a minute of your time. That concludes our program. On behalf of our Trust Banking Group, I would like to thank everyone for participating in this exclusive webinar. Again, I am Charles Tew. Thank you, everyone, and stay safe.